They say history doesn't repeat itself, it rhymes. 2026 has just kicked off, and for the first time in my real estate career, I'm seeing three elements that I have not seen before. Three things that have not happened in almost 2 decades. I got started investing in real estate in 2018. There was huge momentum that was fueled by low interest rates and high liquidity. Many people thought they were reaching a peak, but aside from a temporary drop off that we saw during COVID, there was an upward trajectory that carried us through 2022. Since then, the market has reversed course and has not looked back since. Property values declined as interest rates went up in 2023. We saw income plateau, operating expenses go up, and cash flow really lightened up as a result. The environment is starting to feel a little bit better as people are starting to see value at where pricing is, but it still is really uncertain. The first commonality that I'm seeing across the market are properties being sold at massive losses. Between 2017 and 2022, people were paying massive valuations for properties due to the low interest rate environment. Buildings in LA were trading between 3 and 4% cap rates because interest rates were between 2.5% and 3.5%. People were positively leveraged, meaning that their cap rate was higher than their borrowing costs, until we saw rates rise so rapidly. The people who bought buildings at that time had fixed mortgages for 3 years, 5 years, 7 years, and now those loans have come due. If they haven't created enough property value by increasing the income to offset the borrowing costs, are now in a really difficult position. They either have to refinance and put cash in to pay off the old loan or sell for a sizable loss. Right now, we're seeing a significant amount of properties being listed for sale on the market for less than where they were bought a few years ago. And that doesn't even factor in the cost of the transaction or money that these owners put into the property during time of ownership. Some people are standing to lose hundreds of thousands of dollars on $3 million properties. We sold a triplex in Venice that is now listed for sale on the market for $250,000 less than where they bought it from us. It may not even sell at that price today. The second thing that's much more common today is properties being sold by lenders. Between 2017 and 2022, lenders were getting super aggressive. They were issuing loans on properties where the income was less than the loan payments each month, and over time, that ate through the owner's capital. Those same loans are now greater than the property's current market value, so many of these owners are handing the keys back to the banks. Banks are not in the business of owning real estate, so they really want to clear these properties from their balance sheets. This is now making up a larger percentage of the properties for sale on the market than we saw over the past 10 years. The third element that we're seeing with much more frequency is that new apartments are leasing for less than in-place market rents. Coming out of COVID, the rental market was on fire. The rental market was going up and up and up. But over the past year, the rental market has really softened. It is taking much longer to lease units, and when they get leased, it's typically for much less than where they rented for in 2023 and 2024. These discounts can be between 10 and 20%. Many owners are even giving huge rent concessions to keep the same base rent as they were getting before, but effectively the rent is much lower. Typically, properties were underwritten with a loss to lease, meaning that the in-place rents are lower than the market rents. Now we are starting to see the opposite, where units that were rented in 2023 and 2024 have a gain to lease, meaning that if those people were to move out, the new rents would be lower. Given that operating expenses have skyrocketed, this drop in rental income only cuts further into a property's cash flow. This is potentially the beginning of a new phase in the real estate market. Real estate historically moves really slow. Things that happened 6 months ago, a year ago, 2 years ago may now only be coming to fruition. Will we see more properties being sold for massive losses? Will we see more lenders take back properties from owners? Or will we see owners put more money in to maintain ownership? Will the rental market reset and recover, or will we see rents continue to drop? Where we head from here is definitely uncertain. But what we do know is that these three elements do foster opportunities for us to capitalize on, so long as we believe in our short-term potential to navigate these murky waters and the long-term potential for these assets.